What's up, Coin Bureau crew? Welcome to my first video on the smart money concept trading strategy. This is one of the most widely used and famous trading strategies in both Forex and crypto and can be extremely profitable if used correctly. Because it is so well known, there is a lot of false information out there and this can cause you to get wrecked. Every day I see traders executing this strategy badly. So I'm here to give you the ultimate understanding on SMC so you can trade with confidence and make bank. I've been studying this strategy for years, and at first I know it can seem complex and overwhelming. So we're going to take it slow, and in this video we are breaking down the first and major part of this strategy, which is simply learning to identify bullish and bearish order blocks. In future videos, we will cover further concepts within this strategy such as fair value gaps, change of character, etc., as well as exactly how to execute trades using SMC. Smash the like button and let's get into it. What is an order block? In simple terms, within the SMC strategy, an order block, or OB, refers to a price zone where institutional traders or smart money have placed large buy or sell orders. These zones represent the last area of accumulation or distribution before a significant market move, an impulse move that breaks structure. Don't let this confuse you. Let the info flow over you. It will get easier as we get into it. How to identify a bullish or bearish order block. Identifying order blocks is actually very simple once you have the basic learning down, and this is one of the core skills of the smart money concept. So let's look at it step by step. You need to know how to identify the market structure. Before anything, you need to understand the trend. Higher highs and higher lows equals an uptrend, in which case you're looking for bullish order blocks. Lower highs and lower lows equal a downtrend, in which case you will be looking for bearish order blocks to enter your trades. A break of structure, or BOS, confirms an institutional direction. So, for example, if price breaks a previous high, that is a bullish break of structure, and then you look for the last bearish candle before that break. So here on recent price action for Bitcoin on the daily time frame, we can clearly see that price is making lower highs and lower lows. Then we can also very clearly see the point on the chart where price broke the previous high. This is your break of structure. Number 2. Find the candle before the impulsive move. Once you spot the break of structure for the bullish order block or a buy OB, find the last bearish candle before the strong bullish move that broke the structure. This candle or small cluster of candles is where smart money entered their trades. So here we can see at the break of structure, the last red candle was right here. Number 3, confirm that the move was strong. A valid order block should lead to a large impulsive move with bigger than average candles. You should see a break of structure and possibly an imbalance or fair value gap that we will go into in future. If price just moved slowly or didn't break structure, it's likely not a valid order block. In this example, we can see that just after the break of structure, we had a very strong impulsive move, and this is how we like it to look. Number 4, mark the order block zone. Mark the entire range of that last candle before the impulsive move. From the open to the close, the body only of the candle for your conservative entries, or include the wick for more aggressive entries. This zone is where you can expect a retracement or mitigation before another continuation. And it's as easy as this. Grab your rectangular drawing tool and just draw in the body of that previous bearish candle before the impulsive move and drag out that zone to the right to give yourself space for future price action. Number 5, wait for mitigation and confirmation. After price breaks structure, wait for it to return to the order block. This is called mitigation. Watch for an entry confirmation. You can use my RSI rhyming strategy that I showed in one of my previous videos. Watch out for a liquidity sweep below the zone. And be careful of strong rejection wicks in volatile times. Be sure to always draw in your position. Once you see price mitigating and heading back towards your order block, take your long position drawing tool and drop it in right in the middle of your entry zone. Then once you see price mitigating and moving back towards your order block, simply take your long position drawing tool, drop your entry directly into the center of the order block, and of course bring your stop loss down below the previous major swing low. Then make sure you are giving yourself a nice risk to reward ratio of at least 1 to 3. As always, be sure to use the risk management golden rules of thumb and watch out for one of my next videos on my personal risk management 101. So there it is, not that difficult, right? Keep rewatching this video and practicing drawing in the OBs on your charts until you have this concept down. We will be moving on to execution logic for this strategy in future videos soon. If you've enjoyed the content, please smash the like button, share the video, and subscribe to the channel. Please feel free to ask any questions that you might have in the comments. And as always, please remember to play from a position of power and strength, use your stop loss, and do not get wrecked.